Well, welcome. We're going to have a pretty good group with us today, so give it about another minute, and then we will get started with Laura as the MC and Russ as the meat of the presentation today. So give it about another minute. As I always do for these webinars, if you can. Oh, I've already got it. The hand went up. Look at that. That's a person that's watched too many times. Or so. John got it. I appreciate that. So always want to check that they can hear us okay and see the screen. So you have the one thing that goes wrong like 8 years ago, and now that's a deep scar. So you super panicky every time when you ask that question. So wait again another couple minutes. Got a really good group today, which is good. I've got 12:01, so we are going to get started. So appreciate, again, everybody's time. I know you're going to learn a lot today from our colleague, partner, Russ Willis, and his new book, which is fantastic. He will have a link that I will post in the Q&A to the extent that you get overly frothy and excited about this content and how it can be used for you as a resource to help your clients and your donors make more gifts and have more impact, which is the whole point. So with that, we're talking about PG 103. So again, not 101, 103, but stuff every charitable gift planner should kind of know. I included the little AKA February book club, which would probably not be what most people would join as a book club, but all of you would, and that's the great thing. So you're all geeky just like we are. And obviously, Russ will be taking us through. So I'm Brian Klontz, president of Charitable Solutions, and I've asked Laura Malone, one of our newer team members and longtime friend and sort of colleague outside Charitable Solutions, to sort of MC through today too. So she'll give her background in a couple minutes. I will do some housekeeping in that if you have any questions at all, you can include that in the Q&A. We have disabled the chat, just super funky to scrape post call, but we take all of your Q&A and include that with those from Thursday. And then we have a summary of all the Q&A from both sessions that we then upload to our website with a copy of this video. So we don't send out the slides, as many of you know, but we do provide a full recording of this. And Laura informed me, I'm supposed to know, that we have 52. So 52 prior webinars are on our YouTube channel now, doing these monthly for obviously about 4.5 years. And just really, really glad for this to be our 53rd webinar in that series. So on the next slide, to go through very briefly sort of what we do as Charitable Solutions. So Laura, if you can advance that slide, if you don't mind. So since day one, our mission has been to help make charitable gifts happen that otherwise wouldn't. We do that in some weird ways, I will admit, but it's all around risk management through structure and through aggregation. And so sort of top right there, Emergency Assistance Fund Administration, doing a lot of grants, unfortunately, right now for the wildfires during COVID. You can see there we did about $300 million in grants from 2020 through 2022. About a third of those were international grants. So we have a team of about 125 people on that side, managing individual funds that people can make donations to, typically within employer groups, receive a full charitable deduction as appropriate there, and then the grants going out are tax-free. And so we do that through the Emergency Assistance Fund, the Emergency Assistance Foundation that I created in 2009. We then do, bottom right, a lot of these types of things around training, professional advisors, CE, board, staff, donors, do maybe 60 to 80 of those a year. Laura does speaking, Russ does a lot of speaking, so a number of people on our team do that as well. And it's primarily around sort of this risk management type stuff, all things being equal, or sort of plain giving more generally. I will go bottom middle here, charitable appraisals. Oh my God, we're doing so many of these appraisals right now, in particular for crypto. So it's about 3 to 4 of those a day minimum. I do those and life insurance. We have a great team for business appraisals, I should say. Russ does all of our appraisals for life income terminations, for CRTs, and for CGAs. We have a person that does precious metals, one that does tangible personal property. So our tagline is, if you can give it to charity during life as a life income gift or at death, we can appraise it. And so do only charitable appraisals sort of in this space, qualifying, or I should say qualified appraisals. Then we move into sort of more the core of what we do around, again, risk management and aggregation, and that is gift annuities. So sort of top middle there. Just got another project today, so we're doing actuarial analysis on gift annuity pools, typically more than $10 million, where we do basically stress testing and a number of different ways that we look at pools to help minimize risk, number one, but most importantly, maximizing the residuums, number two. And we do a lot in the sort of the reinsurance designs, or where it makes sense, doesn't make sense, in particular for larger gift annuities as well. Did roughly about $10 million of reinsurance last year. And we both do the design and placement for those as appropriate. For other charities that don't have a gift annuity program, that aren't registered in a particular state, are not doesn't fit their gift acceptance, maybe by minimum age or minimum size, or maybe maximum size as an example, or maybe the asset is unusual, like real estate or crypto or business interest gifts. We created the National Gift Annuity Foundation, which is a completely independent public charity platform. We issue these gift annuities in all 50 states. And you can see there, a little highlighted update, over 1,000 contracts. We had 1,000 contracts, I think, at the end of December, and we're now at about 1,040 contracts. So those are completed gifts that otherwise would not have happened but for the National Gift Annuity Foundation. So we have John Severson on the call today, who helps vice president of that group, and a number of people on that team. And so if you as a charity have a donor that came in and said, I would like to do a gift annuity, and you don't offer them, you can recommend or refer that donor over to us to the extent that we complete it. Most importantly, 100% of the residuum, whatever's left over, is granted right back to you and or to multiple charities should the donor wish. So I think we've done roughly $4 million in gift annuity contributions literally in the last week, for those, again, charities that were not able to issue those directly. And then very, very similarly, our non-cash work. So this is the area that Russ leads, is our business interest due diligence compliance. Literally, I will brag on you, Russ. I wasn't going to do this, but I will. We had a donor, what was it, a week and a half ago? So Russ has less hair today, but about a week and a half, 2 weeks ago, roughly, that had 24 private business positions that had to be completed for reasons I won't go into in about 3 days. And Russ and Ryan were able somehow, some way to do due diligence on 24 positions. I am not saying that so somebody can call us today and say, hey, I got 25. That's not the goal here. I'm not trying to sort of beat that record at all. But the point is that sort of Russ leads that area with the rest of our team to be able to get that done. And it was, I think it was roughly about $55–60 million of value that had to be done within roughly a 3-day period. So to that end, you can see there highlighted about $5 billion of assets have been contributed through our Decami Foundation, a national donor advised fund, and Decami Asset Trust, also a donor advised fund. But over $5 billion through those foundations that otherwise would have been declined. So we're only getting those referrals from other charities that, for whatever reason, timing, like 72 hours, a legal complexity, tax complexity, got a referral over the weekend for a German shopping center. Can't make that up. And we're doing a ton in the crypto space too. So I'm going to highlight a couple of those things as well on the next slide. But the average fee has been about 1.2%. So we are doing all the due diligence, Russ, all the front end, receiving and swallowing the gift, working with the appraisals, working with the team, managing it during the holding period. We had a fun conversation 30 minutes ago about, did somebody turn the gas on? We had to turn the gas off. So all these sorts of things around real estate and management, all the sausage making that most charities are not able or comfortable doing, we do all of that. And at the end, a little bit more than 98 cents on the dollar is granted back to the charity or charities the donor was trying to give it to in the first place, following obviously donor advised fund recommendation and best practices. So that's what we do. So very, very quickly, here's a quick snapshot. You're the first ones to see it. For last year, So this is our activity for 2024. Couple important points. One, the number of our donations nearly doubled. We had about 160 donations in 2023, 160, 286 in 2024. Strangely, the size actually went down. So we received about 1.1 billion in 2023 on the 160. We had 3 or 4 gigantic donations, so well over 100 million per donation. So that skewed it. So now we're at 286 with about 640 million. That still is roughly 2.5 or so million per donation. 286 means we are literally doing more than one donation each business day, right? So there are 250 days in the year, about one a day. Get about 8 to 10 referrals each day and complete that one. Real estate, very consistent. I think, again, based on our 2023 990 analysis, we are still the #1 charity nationally for receiving real estate. You can see those numbers. Business interests, S Corp is understated here because a number of LLCs elect to be taxed as S Corps. So actually, those should be S Corps from a tax perspective. So it's roughly about a third, a third, a third. Key point is it's still about 80 to 90% of everything that we take in the last 5 or 6 years have been business interest gifts. So that's super consistent. What is not consistent is cryptocurrency. Oh my God, went nuts in the last 45 days. So we developed a number of additional processes and services, drove fees way down so that we are now processing a lot more on the crypto side. You can see there's 72 donations for about 104 million. So well over $1 million per crypto donation. And then cash, I sort of won't go into. Those are primarily where we have some donors that want to do direct investments into business, private business interests, or into real estate, or into concentrated positions that we are able to do through our donor advised fund, because then it's illiquid again. Once it's liquid, we then make the grant back out. So this is just a quick snapshot of our actual activity for 2024. Does not include CGA activity and does not include charitable remainder trust activity, which has also been picking up a bit as well. So let me now pass it over to Laura to sort of talk us through the agenda. And I've asked Laura to maybe give a brief background on herself. So she's, again, new to our team, newish to our team, but not new to us. And so had a long and great history of Laura. As soon as I needed somebody, I went out and said, hey, Laura, I would love for you to consider this job. And she did, which is great. So she'll be, again, emceeing for us today. And any questions you have, just put it in the Q&A and I'll hop right off.
Yeah, thank you, Brian. I think that was about a year ago. We saw each other at one of the Council on Foundation events and we got to talking, and here I am. So thank you so much. It's a pleasure to meet everybody. My name is Laura Malone. I am newer to Charitable Solutions as of last fall, working primarily with relationship management, helping with the conversations on the front end of the process with nonprofits, community foundations, donor advised funds, financial advisors, and donors, in helping to see whether or not this gift makes sense for them, helping them, and working with Russ and some of our other team members to do the due diligence behind some of these gifts, getting those gifts completed. And then on the flip side, getting them turned around and converted to cash to grant over to the wonderful nonprofits that we have all over the country that we rely on those referrals for. So thank you very much for your collaboration and your partnership. Prior to coming to Charitable Solutions, I was with my local community foundation of Lorain County, for about 4 to 5 years in the shadows of the Cleveland Foundation in Northeast Ohio. But prior to that, I was with American Endowment Foundation for about 11 or 12 years, working primarily through a lot of their hockey stick of growth as a national donor advisement program, but also launching and leading their complex asset portfolio. Started that towards the end of 2016, beginning of 2017, carried that through till I left in late 2020. And in that time, had done probably about 100 different non-cash transactions through AEF and through those financial advisors and donors there. So thrilled to be here and be part of the team. And I'm honored to be able to introduce Russ. I will say, probably like most of you, Russ was kind of this enigma that I used to follow on the National Association of Charitable Gift Planners listserv, with all the latest and greatest ways that he would share his expertise and his knowledge. And now I get to partner with him at Charitable Solutions. Many of you know Russ as a consultant to licensed professionals and advisor to the advisor on tax and non-tax issues arising in connection to wealth transfers. Much of his practice is focused on structuring charitable contributions of closely held business and real estate interests. Among his other engagements, Russ is a manager of non-cash research for Charitable Solutions, which of course is hosting our webinar today. And then he launched his newsletter, the Jack Straw Fortnightly, which talks about current developments in law, state, federal, tax, and non-tax concerning the transfer of private wealth. And we're here today to talk about his new self-published PG 103, stuff that every charitable gift planner should kind of know. And with that, Russ, I want to give you as much time as we can to share all these fabulous insights. So feel free to chime in with the agenda.
Thank you, Laura. And thank you, Brian, for giving me this opportunity. I would say that I don't feel that I'm in charge or the leader of the due diligence effort. It's a team, and Laura is a key component of that team. If there's a leader, I would say it was Ryan Raffin, but it's fun work. I'm very grateful for the opportunity to do that work. And I want to take an hour or so here today to kind of explain to everybody who has shown up for today's webinar, what is this book? Why did I write it? Who's it for? Is it something that you might want to have, et cetera? And I don't want it to feel like naked self-promotion. Usually when I'm invited to speak at a seminar or a webinar, one of the rules is, you're not to use this platform for self-promotion, but in a weird way, that's actually kind of the purpose here, is for me to talk about my book. So how we're going to approach this is, I want to kind of explain to you why I even wrote it, who I was thinking of as the audience for this kind of book, how I put the book together, what's the organizing principle, how did what was my approach to these materials, and how deep do I actually go into some of the weeds here and there. So that'll sort of be a running theme through here. And so how we're going to approach it is, I'm going to just give an overall chapter by chapter summary. And here and there, I will say, well, here's something in particular that this chapter does mention, a highlight or a nugget. And that'll kind of give you a feel for how, quote unquote, deep into the weeds the book actually goes. It's not all that deep. What's covered, what's not covered, and maybe have some opportunity at the end for people to give some feedback, say, you should include this. I looked at it and you went, way too deep on that, or any of that stuff. And then some ideas that I'm kicking around for, because the minute you release something like this, you already know there's stuff that you want to do differently. So I'm already thinking in terms of what it might look like the second time around. And if there's some additional material that we want to get into, whether that would be a separate freestanding book. So I put the capacity to advance slides in Laura's hands, so let's move. Okay, so who is the intended audience? The materials that form this book, I originally wrote years ago as a series of webinars for one of these commercial continuing legal education providers up in Eau Claire, Wisconsin. I don't know if you've encountered those folks. It's like a hotbed for continuing education. There are several outfits up there. I was already teaching some of their material, estate planning and related tax issues. And I thought, this material would be something that they should have an audience for. So I wrote about 6 or 8 hours worth of material for an audience of primarily lawyers, accountants, some enrolled agents. And what I had for myself, to bring to the table at the time was that I had been doing this work for years. And as Laura mentioned, people see me on the what I still call Gift PL listserv. But I made these webinars. It was probably 10 years ago, 8 or 10 years ago. And then in the meantime, of course, I've had a lot of additional experience working with financial planners, development officers, lawyers, CPAs on these issues. So all of that is sort of the background that informs the content of the book. And how I organize the book, what's the theoretical approach, is that in these conversations that I have with planners over and over and again, they have an idea that there is such a thing as a charitable remainder trust, and that it can have a net income limitation, et cetera, it can flip and so on. But there are gaps in that knowledge, and the gaps arise because their understanding of the vehicle is not really grounded in where did that vehicle come from? Why is it structured that way? Why is the tax law written the way it is? So tax policy was kind of the approach that I was taking in organizing these materials. And then I feel that once the planner understands why the tax law is written the way it is and why you can do this, but you can't do that, et cetera, that helps in understanding which vehicles are even appropriate to the particular situation and how can the particular vehicle be tweaked in order to meet the particular needs of that client. So, and as I say, we'll learn how deep I go into the weeds when we hit these highlights and nuggets. So let's plunge. Oh, well, I've already covered some of this, right? Gift planning professionals. Let's back it up and make sure that I'm not missing anything. Yeah, people like you and lawyers and accountants and so forth who are working with these tools, but they don't fully understand exactly how they work and why. Yeah, so let's just march through these. Yeah, let's go ahead and advance that. So again, my thinking is that if a person working with these tools, I remember my father used to say that, and of course, we're talking about somebody who was born 100 years ago, that he and his friends used to disassemble a Model A on the driveway and rebuild it in an afternoon. There was a time at which people understood how their tools worked, and increasingly we're kind of getting away from that. I have not the least idea how any of the technology works that is allowing this webinar to proceed over the internet. And if something goes wrong, I'm not the person to ask how to fix it. But the tax law is written in such a way as to accomplish particular policy objectives. And once you understand what those are, then you know how the tools work. So let's advance the slide again. So we're not going to go all that deep into the weeds, except here and there. And here and there is a matter of things that I've encountered, along the way, particular problems that have arisen that I think are common enough, and they illustrate particular principles. So, but the idea of the book is not, people on this call, some may remember a book years ago that was put out by the then Big Five accounting firm, Arthur Andersen, which was a comprehensive handbook, desk book, on these very questions. And I still have a copy from like 20 years ago, not even the last edition before they stopped putting it out. This book is not that book. It's only 140 pages long. It's strewn with footnotes because Russ Willis wrote it, but it's really meant to be sort of a story. We begin at the beginning. What is the charitable income tax deduction? Why is it there? What are we trying to accomplish? And then what are all the bells and whistles and wrinkles that have to be placed on it in order for that tax policy to work? So in a way, it's kind of like a story. That's how the book is organized. If it's useful as a shelf reference, great, but it's not necessarily the way it was written. So I think we are finally at the table of contents, I hope. Next slide. Yeah, so the book basically just marches straight forward from basic principles into the particular vehicles. What is the income tax deduction? What is the itemized deduction? Where does that fit in? What do you have to do to substantiate a claimed deduction so that it'll pass muster on your return? And then those are the basics. And then we move into the question of a bargain sale, and we'll see why that's the next thing up. And then that moves into the discussion of gift annuities. And then finally, we get into partial interests, which are the charitable remainder trust, charitable lead trusts, pooled income funds. And then at the very end, partial interest not in trust, which most of us think of as the retained life estate. So that's sort of the organizing principle of the book. And I believe the idea is to just plunge into chapter 1. So what do we talk about when we're talking about the income tax charitable deduction? Well, first of all, we need to talk about what is a completed gift, okay? And what makes something a gift rather than a quid pro quo. And so that's kind of the framework of that discussion. And what does it mean for that gift to be complete so that if it does qualify for a charitable deduction, then the moment has arisen. It happened in 2024, or it hasn't happened yet. So there's a moment at which the transferor relinquishes control. This is a recurring theme in donor advised funds, right? And then there either are or are not situations that could cause the gift to fail and come back to the transferor. That's what they call in future interests law, conditions subsequent. Again, a recurring theme actually in donor advised funds. And then the statute goes into the question of partial interests, because I could give something, in a weird way, this actually loops back to the question of relinquishing control. I could give something, let's say stock, and retain the voting rights. Early on, IRS took the position that's a partial interest because the voting rights are a valuable component of that stock. So they lay the basic rule down for partial interests, and then from that we get all this outgrowth about charitable remainder trusts, charitable lead trusts, retained life estates. Then we need to have a discussion of what's the difference between making a gift to a private foundation versus a public charity. How about if the private foundation is just moving the grants directly through on a current basis? What are these so-called supporting organizations and donor advised funds? That's all sort of basic material in chapter 1. What is the income tax charitable deduction? So then we turn to chapter 2 and we talk about the itemized deduction, because it's there. And this may be the most difficult chapter in the book, because we have these various percentage limitations. If it's a cash gift, you can give up to 50% of your adjusted gross income. If there's appreciated property and some of the appreciation would have been recognized as short term, then we have to reduce the amount of the deduction by the amount of value that would have been recognized as short-term gain. That's all within the 50% limitation rule. Appreciated property contributions for the use of rather than outright to a charitable organization are subject to a 30% limitation. We talk about how all these limitations interact with one another. And then toward the end of that chapter, even though it's not current law, but it may come back at the end of 2025, is something called the PE's limitation. It's named after some congressman who is not only long since retired, but I think now dead. But the idea was at the very upper reaches of high income to limit the benefit of itemized deductions, not just charitable, but all itemized deductions for people in higher income ranges. It's an interesting mechanism, which we're not going to go, there's some weeds we're not going to go into here, although there is a discussion in the book. It's not directly limitation on the deductions. It's basically a boost in your marginal rate if you are claiming itemized deductions. We won't go into that. Those are weeds we're not going into. So here are some highlights or nuggets. In chapter 1, you might be saying, okay, we're talking about the income tax deduction, but when do I have to file a gift tax return? And the short answer here is that if you are making a gift of a partial interest, a qualified partial interest for which you will be allowed a deduction, that alone requires the filing of a gift tax return. Little known fact. An outright gift does not require a gift tax return. If you have other reasons to be filing a gift tax return, then you do also report your outright charitable gifts. So chapter 2, there's a very lengthy footnote in chapter 2 about this whole problem of prearrangement. The Palmer case, all the way up through the most recent tax court decision in Hohenscheid. That footnote alone runs 3 or 4 pages. But there's also a discussion when we're talking about these percentage limitations, and I had occasion to mention this on the GiftPL listserv the other day. If you are taking advantage, if you think you're taking advantage of the temporarily increased limitation for cash gifts through this year, it's 60% rather than 50%. That can have some downstream effects on your non-cash gifts. So any cash gift that exceeds 20% is going to force carry forwards of amounts that would otherwise be subject to the 30% limitation, because the 30% limitation is calculated with reference to the 50% limitation. So this business about forcing carry forwards is true even with the temporary increase of the 60% limitation for cash gifts. That's the kind of into the weeds that we get. So chapter 3, substantiation. Contributions less than $250, you basically need to make sure that you've got your check register. $250 or more, you're going to want some receipts from the recipient charity. You get into non-cash gifts more than $500, you're going to want some serious substantiation. This is all discussed in chapter 3. What we are dealing with mostly over at Brian's firm, and Laura's familiar with this, is non-cash gifts of more than $5,000. And that includes, incidentally, groups of similar items. Think of like a book collection that's going to multiple libraries. When you get to that level, you're going to need a qualified appraisal to establish the value of the non-cash gift. And if you're making a non-cash gift of more than $500,000, you need to literally attach a copy of that appraisal report to your return. All of this is going to require the filing of an 8283 to help substantiate your gift. And the donee is going to need to sign off on that with an acknowledgement. And by doing that, the donee organization is making a commitment that if they dispose of this property within 3 years, they will file a follow-up form, 8282, confirming the price at which they sold it. In theory, there's some matching that could occur at IRS where they say, well, you sold it for 100, but somebody over here claimed a deduction for 500. What's the deal? I don't know how effective the matching is at IRS, but that's the concept. So next slide. Chapter 4. Okay, so now we finally get into planned giving. Chapter 4 is where we begin a discussion of the bargain sale. And as with any such discussion, you will hear all of this is a creature of the 1969 Tax Reform Act. Basically, what happens in a bargain sale is the donor gives appreciated property, but they're actually being paid some amount less than fair market value. It used to be, prior to 1969, that if the price you were getting from the charity was no more than your adjusted basis, you would not recognize any gain. So that's the fundamental change, among 100 others, that came in 1969, basically to the effect, no, it's not going to be like that anymore. You will recognize gain because we're going to prorate your basis in this asset between the gift element and the sale element. And so inevitably, there will be some gain recognition even on a bargain sale. That chapter requires also a discussion of how this all works with the ordering rule among the 50 and 30 and 20% limitations, how it works with the reduction rule if some portion of the gain that you would have recognized would have been ordinary. And then we move into a discussion in this same chapter of the same chapter, back a slide, of the what happens if the property that you're donating to charity has debt attached to it. The rule under the relevant code section, which I think is 1011, is that, or 1001, one of those, I always get that anagram mixed up, is that even though the recipient charity is not actually assuming your debt, it's as though they did. And so the amount of the debt is treated as a realization event, and it's factored in the same way that we just discussed, with an allocation to the gift element and the sale element, and recognition of gain to the extent of the difference between the deemed assumed debt and the portion of your basis that was assigned to the sale element. There is an exception. This on the flip side, the charity is going to be treating this property as though they had acquired it by incurring debt on their own. So this gets into the acquisition indebtedness rules. We don't really go very much into detail in this book on unrelated business taxable income, but that is the implication of acquisition indebtedness. And there's an exception if the debt has been in place without increase for at least 5 years, and the donor has owned the property for at least 5 years. There's what we're calling a 5 and 5 exception. It's not acquisition indebtedness unless the charity actually does assume the debt and starts paying down the debt. Okay, so do I have nuggets for chapter 4? Assuming the transferor continues to pay the debt, which is pretty much the normal course, and in very many cases, the transferor is actually legally still obligated on the debt, those payments should be treated as additional gifts to the charity, generating further deductions. But in brackets here, that statement is made in PG 103, stuff every charitable gift planner should kind of know. But there's no authority cited for that statement. I think it's just common sense, as they say. So let's move to chapter 5, is it? Okay, so we've established this whole concept of bargain sale and acquisition debt. And that, believe it or not, leads naturally into a discussion of a gift annuity, because what is a gift annuity is the donor makes a gift to your charity, and in exchange, you give him something back, okay, an annuity contract. And by undertaking this obligation, your charity has undertaken a debt obligation to the donor in order to acquire the assets that the donor has contributed. So it's acquisition debt. But Section 514C5 says, if you structure the annuity in a particular way, we won't treat it as acquisition debt. So all the rules that you are familiar with about how a gift annuity is to be structured derive from meeting the exception to the acquisition debt rule. That's why the present value has to be less than the present value of the annuity stream has to be less than 90% of the contributed property. That's why it has to be for the life of the annuitant and not for some fixed term or some guaranteed number of payments. And then, if you meet those requirements, then we concern ourselves, well, how do you calculate the value of the charitable gift? We get into a discussion here of 75-20 rates, life expectancy tables, and we make a note, as you well should, that you're going to have a choice. If the 75-20 rates are fluctuating, the donor basically has a choice. Which of these three am I going to use? The current month in which the transaction actually occurred, or either of the prior months? And that makes a difference. It can make a significant difference if the changes are pretty rapid in 75-20 rates. Because annuities are very sensitive, incidentally, to changes in the 75-20 rate. So the value of the residuum gift to charity can fluctuate pretty noticeably over that 3-month period, but there's a trade-off. Because it also affects the portion of the annuity payout that is treated as recovery of your investment, and therefore not taxed. And those work in opposite directions. So basically, your annuitant is going to want some objective advice on which of those three rates to elect. And then we have a discussion in this chapter of, what are the differences in the taxation of the annuity stream if you have funded it with appreciated property, or if you have funded it with encumbered property, and so forth. So I don't know if we have nuggets in chapter 5. The chapter goes on and talks about, well, what if I set up a gift annuity for the benefit of typically a spouse, but it could be some other annuitant. How does that affect gain recognition if I'm funding it with appreciated property? what are the gift tax implications? I'm making a gift now of something that stretches out over the future and has a value probably well in excess of the $17,000 or $18,000 annual exclusion. Does that mean that I want to reserve a power to revoke that annuity so that it's not a completed gift until the annuity is actually paid, and so on? So there's a discussion of that in this chapter. There's also a discussion that runs several pages toward the end of the chapter of the ACGA recommended rates, which I think most issuers do observe, and a brief history of the difficulties that the ACGA ran into years ago with whether this violates antitrust concerns or whether the gift annuity is a security that ought to be registered with the SEC and so forth. So that's all in Chapter 5 as well. Here's a nugget that comes out of Chapter 5. For purposes of that 90% limitation under Section 514C5 that we discussed, the present value of the annuity stream is determined with reference to the transferor's quote unquote equity in the transferred property. So what if the transferor conveys encumbered property in exchange for the gift annuity? The implication of that rule is that you're going to have some gain recognition immediately that won't be spread over the expected return multiple. Okay, that's a nugget from Chapter 5. Fairly deep in the weeds because I don't know how common it is for people to fund gift annuities with encumbered property. I don't know how we're going to do for time here, but we'll just keep marching. So finally, Chapter 6, we finally get into actual split interests. People may think of gift annuities as split interest, but they're really not. It's an outright transfer in exchange for the annuity contract. But now we're finally getting into the partial interest rule. And there's a bit of a history in Chapter 6 about how we got to where we are. So you can't really have this discussion without talking about the Tax Reform Act of 1969. What was the Wild West landscape before 1969? How was IRS trying to address the issues? And what happened when Congress finally stepped in? And then, interestingly, things chugged along for almost 30 years before Congress felt a need to come back in and say, well, you know what? On top of these other basic rules, 5% minimum payout, how we're going to tax the distributions under this worst in, first out 4-tier regime. What do we do about unrelated business taxable income if that's coming into the trust? In 1997, Congress said, there's more that we need to do. We need to require people to have at least a 10% remainder in these trusts. Otherwise it's just like a private foundation. And on the flip side, and this came out of a couple of egregious transactions, we have to put a ceiling on the payout on a current basis. You can't just have a CRT that pays 60% and self-destroys in a couple of years, so that you can take advantage of the tax implications of having a CRT. We're going to put a lid on that, make it 50%. So, and then there's some other basic threshold requirements. Again, all of these are implied by tax policy that are discussed in Chapter 6. What exactly is the maximum term of a charitable remainder trust? What is a qualified contingency that you could put in place that would allow the trust to terminate early? What happens if there's going to be a successor income beneficiary after the first income beneficiary dies, and there's going to be this question of estate tax inclusion? There's going to be a component of that is not subject to the charitable deduction because it's the present value of the successor life interest who pays the tax. And then finally, there's this revenue procedure issued in 2005 that says if you're going to set up a CRT, but there's some possibility that your surviving spouse could make a claim against that asset under elective share rules, we need to have a waiver from her on day one. That revenue procedure has never been actually implemented. It's still in place, though. IRS has not withdrawn it, but they keep postponing the effective date. So that's basically the outline of Chapter 6. And so nuggets here. I mentioned the problem of estate tax inclusion. It's very common, of course, for a well-drafted estate plan to make arrangements in the plan for who's going to pay estate tax and inheritance tax on what and from what sources. And of course, you always want to defend your charitable remainder trust from being exposed to any of that tax because it would disqualify the trust. But there's a revenue ruling from 1982 that says you can have all the lovely tax apportionment language you want in your estate plan, and it can accomplish the result, but it's not good enough unless you also have language in the trust document saying that the income beneficiary, as a condition of receiving their follow-on interest, is going to be required to pony up any estate or inheritance tax that would otherwise be imposed. So it seems to be a requirement to actually have that language in the document. Let's move on. Chapter 7, similar discussion. Well, basically we break it down. That was sort of a broad discussion of charitable remainder trusts, whether they're unit trust or annuity trust. The charitable remainder annuity trust, of course, has this special problem of the possible probability of exhaustion. And it was very much a problem when we had these historically low 75/20 rates just a few years ago. IRS woke up to the problem. They saw that some drafters were attempting to draft around this by installing what we were calling on a couple of slides back the qualified contingency. Okay, and basically drafters on their own were saying, if we ever get to a point where this trust is going to self-exhaust, it terminates early. And in theory, that would qualify the trust because it can never fail. It just by its own terms, it would terminate early. Well, the revenue procedure in 2016 says, yeah, that's a good idea. You can put the qualified contingency language in the trust document, and we will respect that as not implicating the probability of exhaustion rule. Okay. So that's chapter 7. Chapter 8, we talk about the unit trust in its various configurations, the straight unit trust, the net income exception, with or without makeup, and then moving on to the so-called flip trust and the so-called spigot trust, which is a particular way of manipulating the income flow out of an income exception trust. And I think that's where we're going to get another nugget. You will see these spigot trusts around. They are typically funded with an annuity contract, but they could as easily be funded with a single member LLC, taxed as though it were a partnership, I guess. But it's an entity within the CRT that is or is not distributing its income out to the trust. And if the income is instead being hoarded within this LLC, then the trust does not have income, but the trustee is in a position to turn on the tap. This is why they call it a spigot trust, whenever the trustee wants to. IRS has been aware of this situation since at least the mid-90s, and early on, they decided that they were not going to issue letter rulings blessing this arrangement. People were asking, actually, we don't see any rejected letters, but I think they must have been withdrawn when IRS indicated that they were going to issue this revenue procedure. And it has been on the no rule list for however many years that is. I can't do that math. Well, 24 plus 3, right? 27 years. That IRS actually does not bless. They haven't condemned it, but they haven't blessed the spigot trust. So next slide. Again, some planning implications. What if I'm setting up a CRT for the benefit of a third party? We start from the simplest case. Of course, one spouse is setting it up for both spouses, and one of them is going to be a survivor. And we have this issue that we talked about with estate tax inclusion. But if the spouse's interest is deferred to the future, it won't be eligible for a marital deduction. And of course, if the second income beneficiary is not a spouse at all anyway, we have a situation where we're not looking at a marital deduction, and we have to worry about what are the implications of making a completed gift. In the typical case, the settlor is going to want to reserve a power to revoke so that the gift is not complete until the distributions are actually being made. Okay. There is an interesting set of discussion that occurs in Chapter 9 about a CRT for the benefit of a spouse that does qualify for marital deduction. And it qualifies because both the gift tax statute and the estate tax statute say that if you set up a CRT for a spouse and it's an immediate benefit, that is eligible for the marital deduction. It's not a matter of making a Q-tip election. Even though there is a remainder over to somebody other than the spouse, it's not Q-tip, it's not even elective. It does qualify for a marital deduction. And because that's true, you can get into all kinds of planning that you could not do with a Q-tip trust. You can put in a qualifying contingency that terminates the trust early on the occurrence of remarriage, or some other qualifying contingency. And there's some discussion in this chapter of using the CRT as a tool in prenuptial and postnuptial and divorce settlement situations. There's also a brief discussion of a trust for the benefit of a non-citizen spouse. I don't know, do we have nuggets on Chapter 9? No, we're going to move straight into Chapter 10. Had to put in a discussion of pooled income fund, even though, and for completion, right, for completeness, even though it's not a widely used vehicle these days. There was a moment when we have these historically low 75/20 rates when there was a brief burst of activity in this area because of the deemed rate of return on a new fund. And these historically low rates allowed for some pretty low deemed rates of return, which gives you, of course, a much larger charitable deduction for the present value of the remainder. But there's a whole discussion in Chapter 10 of the pooled income fund, which we really won't get into here. And the next slide should be bringing us, the lead trust. So in order to do a lead trust discussion, we have to talk about the grantor trust. That's actually where the basic rule occurs, is in the income tax statute. And the whole business about what powers do you reserve to create a grantor trust here. A lot of activity in this field recently has been short-term lead trusts, where the reversion back to the settlor is greater than 5%, and it's simply a matter of accelerating the income tax deduction into the current year for a 3, 4, 5-year period. But there's also, the non-grantor use of the charitable lead trust for gift planning purposes. Leveraging the gift tax value of the remainder by using the annuity as the leveraging tool, and some discussion of the idea of having these annuity payments start out low and gradually increase. Some discussion of the so-called ordering rule. There was a period in which people were drafting these trusts in a way that was attempting to have the worst income going out to the charities and the better income, staying in the trust for to be taxed at the trust level. And some discussion, again, this was not something where the legislature, the Congress stepped in, but it was a matter of IRS stepping in, the so-called Ghoul lead trust, where they were using a measuring life of somebody who on the tables, had a life of X, but we knew because of health issues that this person would actually probably die sooner. So we were getting the leverage on that person's life, table life expectancy, even though we knew, we kind of knew that the trust was going to terminate early in favor of the non-charitable beneficiaries. So basically, there is an exception to the excess business holding rules if the present value of the lead interest is not more than 60%. Basically, what they're saying is, if you're going to use this to leverage gift tax values, don't expect to be able to use closely held stock to get meaningful results. But if you're actually using it to fund some gifts to charity on an ongoing basis, it's okay to have closely held stock in there. And a brief discussion about allocating GST exemption. So where does that bring us? I think we're finally arriving at not partial interests not in trust So there's this whole discussion of, the retained life estate, most of which you're going to see in personal residences. It doesn't have to be primary, incidentally, just a personal residence. It can be for life. Typically, it's for life, but it could be for a term of years. Then the whole question of, well, how do we deal with depreciation on a property that is obviously going to age? Basically, the answer there is that you're not going to be using your normal depreciation tables. There is some discussion of the fact that in a lot of cases, the charity doesn't really want to own this house when you're done. But IRS early on took the position that they have to receive the property. If they want to sell it, fine. But you can't set it up in advance so that it will be sold at death. That issue was tried in the tax court. The taxpayer actually won on that issue, and IRS ultimately acquiesced. There is a footnote here to a private letter ruling which talks about putting encumbered property into a retained life estate. And I think that may be the nugget on the next page, which brings us almost to closing out. No? Okay. Well, the rest of chapter 12 is the other leg of partial interest not in trust, which is conservation of facade easements. Again, I'm not treating this in the book as something that's front burner for the average planner. But there is a discussion in here about the so-called proceeds regulation, because it ties into this whole problem that we're seeing lately about IRS interpreting the statute, ignoring commentary from the public comment period, issuing guidance without the opportunity for public comment, things like that. And that era obviously is coming to a close with the recent Supreme Court decisions and so forth. And then a discussion of syndicated easements, which is one of the reasons why I don't consider this a front burner for a book of this nature. But there is some discussion of it in chapter 13. And if we're out of nuggets, then we may be, yeah. So what I don't really cover, I mentioned the problem of acquisition debt and unrelated business taxable income, but we don't go into depth on what is unrelated business taxable income, how is it taxed, how do you offset it with deductions for distributions that you're making out to grants to other charities. What's the entire private foundation excise tax regime? We did talk about excess business holdings briefly. What is it with these supporting organizations, type 1, type 2, type 3, functionally integrated, non-functionally integrated, not a center of discussion in this book. The whole problem of what exactly is a qualified appraisal and who are qualified appraisers, not discussed in any depth in this book. The whole subject of accelerating life income gifts, which is a big part of my bread and butter these days, not really discussed in this book. And you may have noticed nothing at all about QCDs, which I kind of treat as a species of outright gift. But I'm willing to listen, and we can have these in a second edition. One of my little pet projects years ago was the question of a charitable lead trust that was structured in such a way as not to qualify. That's also a subject that's not covered here. So having said that, I think we finally got to the Q&A slide. And Laura, have we been accumulating Q's and A's along the way?
I've been answering some of those as we've sort of gone along too. So, but yeah. I appreciate it. We got just a couple minutes left. I was going to show, I've got my copy here of the book too. And I just personally, we have a lot of basic sort of plan giving 101, shoestring kind of stuff. And then we have, like, as you mentioned, sort of the old Anderson WTAS, book at incredibly, detailed. And I love this as sort of in the middle and is hyper practical. And so I think that there's really been a need for that. The other thing, and I want to be careful sort of saying this too, Russ, but to be clear, we did a webinar on AI and some of our new AI tools relative to both for advisors specifically, as well as for donors. And I'm almost positive, and Russ, correct me, I think we've already sort of pulled and inputted this information into our AI sort of engine, or that may be in process.
Paul will be the expert on that. I think he may be doing that. hopefully most of the material in my book is redundant with his other sources.
Yeah. And then Russ, we do have a couple of questions trailing in.
Sure.
One in particular was asking about the super non-grantor class, giving donor gift and income tax deductions. If there's something that you want to share related to the super non-grantor class.
Super non-grantor clat. Okay, charitable lead trust, non-grantor, which means you're primarily using it to leverage remainder values. And what makes it?
Yeah, but they want to get a current income tax deduction. So basically, they might, for example, retain the right to replace trustee or something like that. So they're basically trying to pull it back in. It's a non-grantor trust, but they're actually trying to make it grantor for income tax deduction purposes.
Yeah. Well, I mean, it either is or isn't for income tax purposes, right?
Right.
If you've retained a grantor sensitive power, then it's a grantor trust.
Right.
Yeah. I actually, you're catching me flat-footed on that. I think I may have heard of this concept. It's not something that I have some fluency with in the moment. So,
and then another question that came up was, is there any reason to conclude that the definition of a farm differs for life estate purposes versus 1031 purposes?
oh, I believe that since the statute, which I guess it's just part of Section 170, and the supporting regulations, which don't go a lot farther, they don't go into depth on definition. And for residences, I feel very comfortable going to other parts of the code to determine what's a residence. And I think that the same thinking ought to apply to farms. Elsewhere in the code, there's something about a farm. They haven't gone to the trouble of putting in a different definition here. I would feel comfortable saying probably yes to that. Yeah.
And I think as we're wrapping up, Brian, I don't know if you have any final thoughts, but we have, our past webinars available on our website and on our YouTube channel. So great avenue to check those out. And as Brian indicated, any of the questions and answers from each of those are usually an attachment on our website so that you can read those Q&As as part of that discussion as well, because not all of them do get covered live. So that's always helpful information to have on hand. Russ, thank you again so much for your wealth of knowledge and your great nuggets that you have shared. I definitely picked up one or two nuggets that I was less familiar with. So that's always a good thing to kind of nerd out on some of this stuff. So
no, thank you both for doing this. And Russ too, sort of beyond this book, let's be blunt. I mean, you've been doing gift PL posts for free for 25 years and helping people constantly in the plan giving area and beyond, obviously on the tax law side too, on very complex situations with very well-reasoned, not retained attorney advice, but very well cited, which is appreciated by me well before you sort of joined us.
I believe, thank you. I believe in citing sources. When people get onto a discussion board and they say, here's my answer, I'd like to see some logic to the answer. But no, I appreciate your saying that. And the short answer to why I do this is I love tax law. I just don't have any explanation for it, but I do. So,
well, we appreciate it very much. So thank everybody for your time. I hope it was helpful. And if we do, let us know.
Thanks.